see what happens with developing technology in the space, but in general, Bitcoin is being treated as this global digital commodity. And so really so far, in 12 years of cryptocurrency existence, the only two protocols that have achieved network effects in the grand scheme of things are Bitcoin and Ethereum, and between the two, they're quite different. So Ethereum is more for utility, Bitcoin is more for kind of hard money. We're also seeing, just from the shadows, Bitcoin has emerged from zero to a $400 billion market cap asset class, and that potentially can also serve as a form of global payment. So if you look at the very long term, right? So we already have kind of maybe an outlook for what's going to happen in the next couple of years. But if you look at, if we're trying to envision what the next 10 years looks like, for example, we can kind of start to look at a range of possibilities for what the next global monetary system could look like. And so my base case is essentially a gradual fraying of the current system. So with a lack of kind of central leadership, we start to inherently see more and more decentralization. I look for a gradual decentralization of how global payment networks work, both due to existing technology, just a strong incentive, for some of these countries to want to go down around the dollar-based systems, as well as the new technologies from central bank digital currencies or private stable coins that allow, more ways to bypass the current system. Bitcoin is becoming interesting because we see some of these more rogue states explore its use as a way to bypass sanctions. So we see, for example, Iran, dabbling in Bitcoin potentially as a way to go around any sort of sanctions, because Bitcoin is, of course, decentralized. Transactions can't be stopped between willing parties. We'll see what happens with developing technology in the space, but in general, Bitcoin is being treated as this global digital commodity. And so as we kind of go forward, and as we have this period of currency debasement with currency spending most of their time yielding below the inflation rate, you could have potential periods of defaults where companies, even though equities could do reasonably well, you have high valued growth stocks, you have lots of junky companies out there with junk debt, and so Bitcoin and gold and these other things like that kind of represent a little bit more pure way to potentially preserve part of your wealth through this decade. And so of course gold is the lower volatility blue chip, whereas Bitcoin is this growing network effect that's starting from a much smaller base and has a lot more volatility and uncertainty to it. But I do think that going out long term, it's very likely to continue to accumulate value, because I think it has demonstrated the fact that its network effect has reached critical mass and has really separated it from any of the other coins, especially the ones that are specifically trying to be stores of value. So I view Bitcoin, for example, as an emergent store of value. So it's because of its volatility, it's kind of currently being in the process of finding its total addressable market. So it's a very volatile asset. So it's basically, technically, it is a store of value that can be self-custodied and basically held outside of the system, similar to gold. But because it's so volatile, it's more like it's an investment in the idea that it's becoming a store of value rather than one already, except for people that are really hardcore with it and kind of just completely ignore that volatility. I would say that Bitcoin has more real-world use cases because, unlike gold, Bitcoin can be continuously updated and built upon with extra layers. And so what we're seeing, for example, is we're really kind of seeing the lightning layer start to hit critical mass, which is essentially that we have the second layer protocol, so you can do cheap, nearly instantaneous transactions. And that's one of those things. I mean, that's been a work in progress for a while. The white paper came out in 2015. Then they did some, basically an agreed upon set of specifications in 2016 to make, different companies' implementations of Lightning interoperable. Then the SegWit update to Bitcoin in 2017 really allowed Lightning, as we know it, to start building on top of Bitcoin. But then from there, it took a couple years to build out the tools, build out the liquidity. So if you look at like a channel map from 2018 compared to 2021, it's like night and day. And so as we've kind of built that network out, or as people like Elizabeth Stark of Lightning Labs, Blockstreams are working on it, there's different implementations of it. But as those developers have built out those tools, I think that's kind of expanded the use case of Bitcoin, as we're starting to see in places like Bitcoin Beach of El Salvador, as was on display a little bit at the Bitcoin conference. And so overall, I do think that Bitcoin, ever since around 2018, I think it's become a pretty credible macro asset. It's reached a large enough market capitalization that it's kind of on everyone's radar. And then it also settled some of the fork wars back in 2017. And so when you have that combination of a credible, very difficult to change, underlying protocol and monetary policy, and then you can build other things on top of it, or side chains, or like Lightning secondary layer. That's a really strong network effect to pay attention to, and the network effect is both on the first layer, and then increasingly we're having a network effect happening on the secondary layers as well. Yeah, so basically, Bitcoin is, as you point out, it's a commodity. Both in terms of the SEC does not consider it a security. It's a commodity because there was no pre-mine, there was no initial coin offering. It meets all the a lot of definitions of a commodity. It's not an industrial commodity, but it basically, for all intents and purposes, it's a commodity, and it's similar to gold in the sense that it's a monetary commodity, and so it's something where it's got a scarce supply, and people can go into it knowing that it can't realistically be debased. Now that the risk there, and kind of what made cryptocurrencies challenging for people to wrap their head around, is that anybody can create a new cryptocurrency. And so that can indirectly threaten the scarcity of the top protocols, where, okay, Bitcoin's only got 20 million coins, but if I make Lyn coin and it's a copy of Bitcoin, and I make another 20 million coins, well, now there's 42 million. And so there has to be a way to differentiate Bitcoin from Lyn coin. And the analogy that I've used a couple times is, for example, if I copy Wikipedia, I can copy all the text on it. I can copy it, download it. They actually make it easy to do, and I can host it on lynalden.com. And the problem is, I can copy all the text, even the pictures if I want. It'd be a little bit more data, but the text is actually a very low amount of data in the grand scheme of things. And I can do that. But the question is, will I get anywhere near the traffic that Wikipedia gets? And the answer is, of course, no. Because what I can't replicate is the network effect that Wikipedia has. So Wikipedia has millions and millions of links around the world pointing to different pages in Wikipedia, and it has an active editing community constantly improving Wikipedia. And so it's impossible for me to get those links to point to mine, or at least 99% of them, and it's impossible to get most of those users to come over and edit my version instead. So my version is going to be like this lame shadow version of the real thing. And so the same thing happens with Bitcoin. We have these other ones come along, these hard forks or these kind of duplicates, but they don't capture the market, market capitalization. They don't capture the security, the hash rate backing it up. They don't capture the developer base, and so most of the network effects retain on the main chain. And so really, so far, in 12 years of cryptocurrency existence, the only two protocols that have achieved network effects in the grand scheme of things are Bitcoin and Ethereum, and between the two, they're quite different. So Ethereum is more for utility, Bitcoin is more for kind of hard money, and so you have those two kind of breakaways from the rest. As all these different countries try to build their own system, we're also seeing just from the shadows, Bitcoin has emerged from zero to a $400 billion market cap asset class. And that potentially can also serve as a form of global payment. We could start to see it show up on some of these smaller central banks that are not at the heart of the current system.